So last year at the Euromoney conference, Daniel and I were on a much larger panel that was looking at how do we develop the ecosystem for digital financial services. And we talked about many of the challenges that are faced, but one of the things we talked about were the challenges that fintechs face in financing their operations. They're new, they're younger, they have a hard time getting banks in particular, but also local financiers to fund their operations. One of the things that Daniel said that I absolutely loved was that they walked into 30 banks trying to get financing for Branch, and they laughed them out of the room. Between then and now, Branch has been able to raise local debt, and we're going to talk about that a bit later. And I'm also joined by Piso Sengir, who is from Kopo Kopo and is also going to talk about the journey that they've had in getting local and global financing for their operations. My name is Tamara Cook. I'm the head of digital innovations at FSD Kenya. We are all about creating value through financial inclusion here in Kenya. And for those of you who were here this morning, my colleague Victor Malu was also on the panel. First, I'm going to ask Daniel Salpak, who is the head of global operations for Branch, to explain what Branch does in terms of providing alternative financing for Kenyans.
Thanks very much. How's the audio? Can people hear? Good. So thanks, Tamara, for guiding the panel and to Euromoney. A little bit about Branch. I know there's a lot of jargon in the fintech space, so I'll just kind of cut out all the jargon and get to the simplicity. Branch has developed an Android application that allows anybody in Kenya, Tanzania, Nigeria, and soon other markets to download the app and within seconds apply for an uncollateralized loan, and in seconds from there to have money in his or her mobile money account or digital wallet. We launched in Kenya a few years ago. We've dispersed hundreds of millions of US dollars already, and it's been an interesting journey, so really exciting to talk about it today.
Great. And Peace, can you tell us about Kopo Kopo, both kind of as it has evolved its business model over the last few years?
All right. Thank you, Tamara, and the organizers for having me. Kopo Kopo has had a very interesting journey. When it started in 2010, it started more of a software provider for microfinance institutions, and then quickly realized the decision-making process and the turnaround time is really long when you're selling software, especially to a bank or an MFI. And that's what really prompted Kopo Kopo to think about, here we have a solution, what we call the business operating system, that enables you to aggregate all your payments. So basically what that means is, as a customer, as a business owner, you can receive payments from multiple providers, from Lipa na M-Pesa, from Masterpass QR, Airtel Money, you name it, and it all reflects in one central wallet. So it really enables you to have a one-stop shop to manage all your transactions. So Kopo Kopo had to think about, if it's taking us this long to be able to sell this particular solution, how can we internally leverage the solution to be able to drive a business model? So that is what then inspired our partnership with Safaricom. So initially, when Safaricom tried to launch Lipa na M-Pesa, I think it was called Lipisha or Lipa, a very different name. And it was not really gaining traction, and they're almost shelving the solution. And Kopo Kopo came in and said, okay, look, give us the chance to be able to roll out this solution and see if it can really make a difference in the market. We went into an aggressive acquisition campaign in terms of really getting to sign up customers to take up Lipa na M-Pesa as a service. And over time, we've grown up to become Safaricom's biggest aggregator of Lipa na M-Pesa. Fast forward, as you know, the rates of Lipa na M-Pesa evolved over time. When it started, I think as a customer, you paid about 2%. No, as a business owner, you paid 2% for accepting Lipa na M-Pesa payments. And after a while, Safaricom revised the rate to about 1%, which then meant our revenue was cut by half. So we had to be very creative in terms of, if we are to be able to survive as a business, we have to think about what are alternative ways of sustaining our operations. And that's what inspired us to get into the merchants lending business. So at the moment, Kopo Kopo offers merchants, we call it a cash advance solution that ranges from as little as 10,000 shillings up to 5 million, depending on the type of business that you operate. The only prerequisite is you must be accepting cashless payments. So that's either Lipa na M-Pesa or Masterpass QR. We partnered with MasterCard last year to roll out Masterpass QR to our merchants. So really it's figuring out, how do we leverage the history and the digital footprint that we have of you as a customer to be able to use that as your collateral for lending. With our internal algorithm, we're able to advance the customer's credit within 24 hours for new customers, and within an hour or two for repeat borrowers. So for us, it's really been how do we add value to our customers, whether it's through cash advances, whether it's through bulk payments, or whether it's through helping them with loyalty campaigns. That's what we're always looking about. How do we add value to the merchants?
Great.
Yeah.
So we've got two fintech innovators here, both of whom are doing a lending business. And you're mostly bankers in the room. You know that a lending business requires lending capital. And I think both of you have got international equity investors who have invested in your business, and you started out by lending with those funds.
Yep.
But I'd love to hear a little bit more, Daniel, about what's happened since last year when we were on the panel. How have you been able to, you already had some global debt, but how have you also been able to raise some local debt, and what's been that journey like for you?
Yeah, sure. So I think a year ago, we may have had a little bit of global debt, $2 or $3 million, but we're financing all of our loan transactions through our equity book. And I think when we were discussing, I had explained our journey of chatting to bankers in Nairobi and asking for debt. And obviously, given the environment with Imperial Bank, Chase Bank, and all the bonds that had defaulted in the market, there really wasn't much appetite. And so kind of, from one bank to another, the story was the same. We didn't have any assets, we weren't profitable at the time, and we just weren't an appealing story. So we decided to kind of look in the high net worth market, in the commercial paper market, for those folks that were prepared to take a little bit more risk and accept a higher yield. We worked with a firm called Nabo Capital, which is a division of Centum, now called Barium Capital. They've rebranded. And they were able to work with us to go out to market and put together a small issue of 2 to 3 million US, which sold very quickly. It was a 6-month paper, which we paid off in December of last year. And I think it was a landmark transaction because we were able to securitize that transaction with our receivables.
Daniel, can you just talk about how long it took you from when it was released to when it was full?
Yeah, it was quite amazing because we have pretty good sponsorship in the U.S., some of the best venture capital investors. Our CEO is really well known in the lending world. So we really had a great equity, a sponsorship story. Great equity investors on board. We started putting together the issue. Took us a month to put together, do the offering materials, and then the following month, we went to market. Nabo went to market on our behalf. And I remember I was taking vacation halfway through that month, and I told the guy leading the transaction, make sure you keep X for me. I want to buy a little bit of this paper. I came back from vacation. It had all sold. So it really moved very, very quickly. It was 3 to 4 weeks from start of the transaction to close of the transaction. It was a small issue.
How many of the banks in here do you think could do that? I'll leave that as a silent question. Great. Well, thanks for sharing that. And I tweeted earlier a link to an FSD Kenya blog that tells a little bit more of this story and some other fintech financing deals in Kenya on the FSD Kenya website. And thanks to Branch for allowing us to kind of tell a little bit more of that story last year. Peace, tell us, your journey's been a bit different.
Yes.
So tell us a little bit more about your journey and where you are now, as much as you can say.
Yeah, so our journey initially, when we were raising capital, it was more around really building the business operating system. So that's the pitch that we went to US and European investors. They're the ones who seemed more open to investing in an idea. And a lot of the times with fintechs, it's always about selling an idea. It's not something concrete. It's someone coming and saying, look, this particular product has the potential of growing 10 times in 5 years or 6 years. So you have to have somebody who has either the vision or has patient capital to be able to invest. So for us, the first equity investment that we got were mostly from social impact investors. So these were investors who said, okay, we'll give you that money. We're not expecting you to turn around overnight. We're not expecting to cash out overnight, but we'll walk the journey with you. When we were initially setting out the business operating system, we were aggressive because that's what we had promised to the investors. And to a point that we said, okay, it is taking longer than we had anticipated to roll out this solution. So when we were looking now to venture into lending, initially we were not sure what the traction was going to be. So the amount of funds we had allocated to lend out was not that much. Within 2-3 months of starting the lending, we realized, no, we don't have enough funds to continue lending. So we had to really slow down our lending to be able to regroup and
anybody
ask for
who's done a
funds.
lending business knows that's not good news for your borrowers.
Exactly, yes.
You need to be able to promise them additional funds, bigger loans in the future.
Exactly. So the natural place for us to have gone for funds to be able to on-lend was to local banks. But as Daniel mentioned, if you're going with a P&L that has been making loss over the last 3 years and a balance sheet that is not quite heavy, banks rarely will look at you and say, come back when things are looking up. So what we had to do, actually, we slowed down lending for about 3 months and go back to original investors and said, okay, this is a potential business, it has legs, are you able to put in more money? So we were fortunate enough to be able to put bridge financing. Right now, as we're looking to now scale further, because as fintechs, you're limited by how much equity capital, how much funds you have on hand. What we're looking at is really how can we grow the SME financing business, because there's definitely a need in that space. We've had discussions with potential investors. Most of them tend to be American and European. I think Kenyans are a bit shy. The risk is too high. Nobody wants to touch you. So it's really finding the right mix in terms of these investors and saying, okay, are we the right ticket size? Do we have the right business model, the right fundamentals? And is there synergy between our board and the incoming investors? So that for us has been our journey.
Yeah, great. Daniel, as you think about the mix of financing between global and local, especially on the debt side, how are you thinking, how is that right now, and what is your vision for how you hope that will be in the coming years?
Yeah, great question. So we've just announced our Series B. We closed a $70 million round, combined both with debt and equity. And it was all, in fact, USD from international institutional investors. We would like over time to mix that with some Kenya shilling element. So as our book grows and as confidence in the branch business kind of continues, we'd like to reduce a little bit on the USD international side and increase the Kenya shilling side. It's just so much easier to raise USD debt from big players that are happy to kind of look at $200, $300, $400 million numbers. So the conversation started there. It was much easier to close, but I really hope that Branch will have a bond in the Kenyan market at some point, in the next few years. It's going to take time. It's going to be a process, but that's ultimately our game plan, to get a bond in the Kenyan market that can grow with our book as our book grows, and it can work with our international investors.
And have you been able to access any local financing yet in Tanzania, Nigeria?
No, we're starting that process. Nigeria is a new market for us. We are there less than a year. So we're financing that mostly through our equity position. I would expect in the next year to raise debt in the Nigerian market. We're starting conversations. And Tanzania, the same.
Great. And are you doing anything about hedging right now, or is you just hoping?
Yeah, our hedging strategy is a hoping strategy right now. We're going to become more sophisticated in hedging this year. We've asked a number of banks for some ideas. We're going to kick those around and think about how we want to do things. We don't see it as a huge risk right now, but obviously with the Nigerian currency and with the Nigerian portfolio becoming quite large for us, we will, without a doubt, build a hedging strategy into 2018.
Great. So many of you in the room may already know Peace and know that she has not always been a fintech entrepreneur. She used to be a banker, and she worked at Commercial Bank of Africa and really helped launch the Mshwari offering. She also worked in the US at Amex. And so I would love for you, Peace, to compare what it was like as kind of a fintech startup within a bank and how you financed that, and kind of contrast that to your experience at Kopo Kopo.
Okay. A fintech within a bank, I think for us, the important thing was actually to have a very separate location from the traditional banking space. So the Mshwari team, for instance, was based in Westlands when the main bank was in Upper Hill. So it's almost like its own space that gives you the creative freedom to take risks from the traditional banking without there being limitations in terms of where's the collateral, how, what risk assessment do you use, can you back it up? So really having that space to be able to think and develop in its own right was very important. The advantage of Mshwari being in a banking setup was the funding was provided by CBA. Being a bank, you're able to finance the operations. As the loan book grew, the bank was able to, inject more money. So we never really had to worry about how fast the portfolio was growing. In addition, the Mshwari product, as most people might know, is the savings and lending product, micro lending product. So already there are deposits that customers are able to inject into the business. A lot of times we think it's 100 shillings, 20 shillings, but it adds up. You'd find overnight you'd be, holding tops of over 4 million, shillings. And really being able to leverage that money to on lend was very important. So for us, being in a bank setup, there's really no worry about capital. You can grow as fast as you'd like, as long as the risk tolerance of the board is within acceptable levels.
You went from being a net borrower from the rest of the bank to being a net deposit provider of deposits to the rest of the bank.
Exactly, yes. Because initially, we were thinking we're going to have to keep getting financed by the bank, but over time we were actually the ones, generating a lot of deposits for the bank. From a fintech perspective, in terms of Kopokopo, it's a very different ballgame. Your growth is limited to how much equity you hold, how much you're able to fund your daily operations, which then eats into the available cash. So how quickly you can grow is really a balancing act every day. And how much risk you can take is also still a balancing act. If I give a customer, 5 million, I give 10 customers 5 million, that's 50 million that could overnight wipe out our portfolio. So with the fintech space and Kopokopo, there's always that balancing act. There's always around, do I have sufficient capital to meet these needs? With the CBA and Mshwari example is customers already pre-funding my lending. My cost of funds are relatively low. If I need additional funds, we're already a bank. You just need to email the CEO or somebody at the board and write a board paper and give a rationale for the financing. So that really was the difference in terms of how you can quickly scale and get financing.
Oh, great. Thanks for sharing that. I think it's an interesting juxtaposition of those two experiences. So we heard a little bit this morning from both the governor and the deputy governor of the Central Bank of Kenya about the importance of the regulatory environment in encouraging or walking alongside, is the word that was used, the words that were used of fintech innovators. I'd love to hear from you, even though it's not necessarily the topic of this, but how the regulatory environment either enables or impedes your ability to operate and provide alternative financing here in Kenya. Daniel, you want to start?
Yeah, sure. I can kick off. I think Kenya's done a great job on the regulatory side. When I compare kind of Kenya, Tanzania, Nigeria, I think Kenya's done really well. I think it's going to be important for this space to be regulated. I think one of the key concerns is making sure that Kenyans don't become over-indebted. And so at some point in time, we're going to all need to kind of think about how do we ensure that over-leverage is not taking place in kind of the micro-enterprise sector. We do it ourselves. We have our own ways of monitoring that, and that features into our data science model, our machine learning data science model. So I think regulating that aspect is going to be important. I think the continuing trends on privacy regulation, I know there's a bill coming. We'll participate in that process. I think that's also important to safeguard the consumer. I think we're seeing with Facebook and all that, this is a really important topic, so we've all got to stay on top of that. So I would encourage that privacy bill to get pushed through and stakeholders to contribute. I think the other area that's really good in the Kenyan market is the CRB, the Credit Reference Bureau system. Tanzania, we don't contribute any information on good borrowers or bad borrowers, would like to. But in Kenya, we can, and it's useful and it's helpful.
And you provide both good borrowing and Positive and negative information?
Currently, we only provide bad information, negative
And when are you going
information.
to start providing good?
It's on our roadmap for in fact, next quarter.
Ah, great.
So
We look
just
forward
one
to
of the
that.
many things that need to get done by the engineering team, a few tweaks on kind of what information we provide. So that's, that's in our product roadmap. So yeah, I would highlight those three elements on regulation, but
Yeah.
we're impressed in Kenya.
That's great.
Yeah. For us, I think the regulatory environment has been favorable, given that alternative lenders are not yet regulated. But despite that, we always ensure that we follow best practices. We try to create transparency in terms of fees, so a customer can actually see what they're going to pay back. We provide,
And your transparency is in the amount to be repaid instead
Yes.
of a percentage or something because they understand that better.
Exactly, yeah. We give you the amount to be paid. We said, you're taking this amount, this is how much you're actually going to pay, this is total what is due, and this is the duration. So we try to be as transparent as possible. And we actually go to the extent in which if a customer selects a credit, because our cash advance fees is based on the duration of payment and your
Sure.
risk profile. Sometimes you have customers, either you're in a desperate situation, so you pick the maximum amount and the fees become really ridiculous. So we actually call the customer and talk them down and said, we know you want 100,000, but at 100,000, this rate may not be the best for you as a business person. Would you consider taking 50? So we actually, convince the customer to take a lower rate to ensure that by taking the credit, we're actually helping them grow and we're not eating into their profitability. When we're doing the risk assessment, we just don't give anybody who asks for credit. That would be the easiest thing to say, let's grow our loan portfolio as quickly as possible. Anybody who asks for credit, give. No, we actually go through the exercise step and say, what is the use case for this loan? Is it really going to add value to you as a customer for you to be able to continue servicing the loan? We also do CRB checks because we don't want to contribute to the bad book.
And do you provide bad debt as well as good debt? Data?
It's in the roadmap for the good.
You heard it here. It's in the roadmap.
It's in the roadmap. It's in the roadmap. We're in discussions with both the two CRBs just to be able to provide the positive information as well. But currently, we are providing the negative listing and also really educating the customer through their journey to ensure that they don't end up with the CRB because we don't want to be part of the problem in terms of bad loan books. Yeah.
And we heard a little bit of mention around transparency and also multiple borrowing that's happening some in the market. There's a survey that was just done as part of the FinAccess partnership with Central Bank of Kenya, Kenya National Bureau of Statistics, and FSD Kenya that was looking at digital credit. And one of the things that we found is that 14% of digital borrowers are currently repaying more than one loan. Now, that doesn't mean necessarily that that's a bad thing. It just means we need to find out more. Sometimes people can't get as much as they want from one provider, so they maybe borrow from two places. And if their credit capacity and ability to repay is there, then that's fine. But I think we do want to look for these signs to find out if people are borrowing to repay other loans. That's obviously a worrying sign, and we're seeing some of that. There was also some mention this morning about sports betting, and we do see that those people who borrow digitally are more likely to engage in sports betting. We're not saying that there's a causality, we're just telling you that there's a correlation. Great. Well, I think we're almost out of time, but in our last few minutes, Danielle and Peace, I'd love to ask you to think just for a minute about what advice you'd like to provide to this audience. There's bankers, there's fintechs, there's government regulators in the room, but as you think about kind of what's next for Kenya and how Kenya can provide more value-added finance to Kenyans, what can the people in this room do?
Yeah, maybe I'll kick off. I guess it's more for the regulators. The bankers, they'll hear from me again. I'll come knocking, so expect me to come knocking, and we can talk. But I think from the regulator perspective, as this sector becomes regulated, I encourage the track that they've already taken, which is let's wait and see. Let's not act too quickly. Let's not suffocate an industry before it's given an opportunity to kind of shine. When I talk to my customers and hear the use cases of the digital credit we provide and the use cases for it, it really brings tears to my eyes. I know that we are doing some great stuff and we're changing lives, $5, $10, $20 at a time. So there's really huge opportunity, and to do this globally, which is our vision, is a really exciting one. So it would be great if regulators allow us to see this journey through a little bit.
Great.
I think for me, my message would be to banks and any potential investor within the Kenyan market. A lot of fintechs within Kenya would love to have local debt or local financing. That would be our preferred number one, stop. So if the financial institutions are able to increase their risk appetite, have a bit of a paradigm shift from the traditional models of lending and think about how can they be positive players in that space and be able to see what potential there is in that particular opportunity and be able to provide wholesale financing to this, to the fintechs or whoever is in this space. There's a lot of opportunity for growth. There's a lot of ecosystem collaboration that's required. And I think if banks are always looking to grow their loan book, the fintechs are the first place to go. The only thing is you may have to rethink twice about the strength of the P&L and the balance sheet and think about the potential of the business.
Great. Yeah. Well, thank you so much again for joining us for this panel on alternative financing that's both for the Kenyan market, but also alternative finance that innovators need to provide that financing. So please join me in thanking Peace and Daniel.
Thank you. Thank you.